Before we end the first accounting cycle, I wanted to review real quick the first steps of the accounting cycle, which it covers chapters 1 through 7 in the textbook. So to begin with, we started with step 1, which is analyzing transactions. And so when you analyze your transactions, you start by deciding which accounts are affected. Supplies, cash, capital, whatever. What are the accounts that are affected by the transaction? Then you decide how are they classified? Are they assets, liabilities, owner's equity, revenue, or expenses? Those are the sections covered so far. Then you decide how are they changed? Do they go up or do they go down? And then you have to decide how it is entered as a debit or a credit. And so you are to the point now where most of those transactions that we've looked at, you just automatically kind of know what they are. But these are the actual steps we learned as we went through how we analyze our transactions. Then you journalize them. Once you know cash is an asset and it's going to go up with the debit, capital is an owner's equity account and it's going to go up with a credit, you can now journalize that transaction. And when you journalize them, you start with your date, and then your debit, write the debit amount and or debit title and debit amount. Then you do the credit title and credit amount, your source document, and you've journalized that transaction. And you do that with every transaction that you journalize. Debits always go first, remember that. Then we talked about the chart of accounts, and this is the picture of the chart of accounts for Delgado Web Services. And I just wanted to review real quick of what the account numbers mean. Right now we have 3 account numbers. The first number tells what division does that account go in. So supplies is an asset. Assets are first. They're 100s. They all start with 1. Then the next 2 numbers are the location within that general ledger division. Remember, our account numbers always go by tens, and that is because if we needed to add 1 in there, we could go in between it. So if we needed to add in maybe a postage expense, P comes after M, but before S. So if you added postage expense in there, it would be 565. So you could go by 5s. If you wanted to add 1 at the end, like utilities expense, then it would be 580. You'd go by the 10. And I also wanted to talk just for a moment about how you know what order these go in. So liabilities, owner's equity, revenue, and expenses are always going to be alphabetical because capital comes before drawing and accounts payable, can and office supplies. On the liabilities, they all start with accounts payable and you go by the first letter of the name of the company. So Canon comes before Mountain. If these were people, you would go by the first letter of their last name alphabetically. Expenses are always alphabetical, and right now we only have sales in our revenue account. Assets, however, go by liquidity. Liquidity, if you remember, is how liquid is the asset? How fast can you turn it into cash? And those are listed in that order. Accounts receivable are alphabetical, just like liabilities. They go by the first letter of the name of the company. If it's a person, it goes by the last name of the person. So everything is alphabetical except assets, which are by liquidity. So then step 3 is posting. And when you post, you're going to go from your journal to your ledger. And we have a ledger account for each separate account that we have. So in this example, they're posting the cash. You start with the date, then the journal page number, then the account. If it's a debit, it goes to debit. If it's a debit in the journal, it's a debit in the ledger. If it's a credit in the journal, like this one over here, then it would be a credit in the ledger. But these just show all examples of debits. Then you figure your new balance. If there's no previous balance, you just bring that balance over. Debit here, debit balance. That's what these 2 columns are the balance columns. In this example over here, we had a previous balance. It's a debit balance, debit transaction, so you add them together to get your new balance. If it was a debit balance and a credit transaction, you would subtract them to get your new balance. Then you go back to the journal and you put the account number in the post reference column. That's very important because that tells you whether you've posted that transaction or not. Then step 3 is at the end of the financial or the time period, at the end of the month or whatever your accounting period is, you're going to prepare your worksheet. You start by preparing your trial balance columns. You do that by going back through your ledger, and on the worksheet, you list every account in your chart of accounts and in your ledger, whether it has a balance or not, in the order that they go. Again, that chart of accounts starts with assets, then it goes to liabilities, and then owner's equity, and then revenue, and then expenses. So that's the order you list them on the worksheet. You put the balance that is in that account, then you add those up to make sure your debits and credits are still equal. If they are not, you have to find that error. And if you remember, we talked about errors. If it's a difference of 1, like a penny or $10, it's usually addition. If it's a difference of 9, it's probably a transposed number or a slide error, but you could go back and review those different errors. So you always have to make sure these equal. If they do not, you cannot move on. You have to make them equal. Find your errors before you move on. Then step 2, you do your adjustments. Remember, supplies and prepaid insurance, we adjust. So you go do an inventory of your supplies to find out how much you have left, and then you adjust for the difference. So in this example, the beginning of January, they started out with $620 worth of supplies. At the end of January, they had 90, so they had to adjust it for $530. We had to pull $530 out of supplies. So debit balance here, you got to reduce it, so you're going to credit it. Every transaction has a debit and a credit, so you're going to come down and you're going to put that to supplies expense because those supplies you used are an expense of the business. Then you do the same thing with prepaid insurance. Add those columns up. Then you're going to extend your columns. You're going to extend to the appropriate financial statement. So the balance sheet is first. The balance sheet accounts are those accounts that tell us whether our accounting equation is still in balance. Our assets, our liabilities, and our capital and dry. So assets equals liabilities plus owner's equity. Those accounts are brought over to the balance sheet columns. Now remember, with supplies and prepaid insurance, you have to take that adjustment into account. So you start with this, debit, credit, subtract, leaves you with these two balances. If when you're doing this and you have a mistake on your worksheet, a lot of times you need to double check that. That's going to be that first mistake. Then we come down and we're going to do our income statement. Our income statement is a financial statement that tells us whether we have a net income or a net loss. That's why it's called income statement. That is the difference between our revenue, money coming in, and our expenses, money going out. Remember that income summary account right now has no balance, so that's kind of your divider. So sales is a credit here, has to come over to a credit here. All of our expenses are debits, so they have to come to debits. Now, insurance expense and supplies expense have nothing in the trial balance, but we have those adjustments in the debit column. So you have to bring those over to debit. Then you add those columns up. Remember, those 4 balances will not equal, but what you're going to do is figure the difference. So you're figuring your net income now. The difference between your revenue, which is the income statement credit column, and your expenses, the income statement debit column, is your net income or net loss. If revenue is bigger than expenses, you have a net income. The difference of those two is $3,162 in this example. So you bring that down to that line and write net income on the line. And the reason we bring it under that lower amount, the expenses column, is so that when we add those together, these two balance. Then you do the same thing with the balance sheet column. And the difference between the balance sheet columns should be the same as the difference between the income statement columns. It's kind of a double check system for you there. Then again, you put that amount under the smaller one, so when you add those down, they equal. So at the end of this, your income statement column should be the same and your balance sheet column should be the same, but the 4 are not going to be the same. These 2 are going to be the same, these 2 are going to be the same. And that's your worksheet. If these do not come out, you have to find your errors. That's the whole point of the worksheet, is to find if you have mistakes and get them fixed before the end of the fiscal period. Then you're going to journalize and post those adjusting entries. All you're going to do is go back to your worksheet. Your first one is supplies. You're going to journalize it. Remember, we don't have a source document, so we center the word adjusting entries on the line on the journal page, and then we do our adjusting entries. Then you do your prepaid insurance one, just like they are in, you're just copying them from the worksheet, and then you post them, and then they bring those accounts up to date. So if you remember back here on our worksheet, told us we should have $90 in supplies and $750 in prepaid insurance. After you journalize and post those entries, your ledgers are updated. Then step 6 is preparing your financial statements. So the first financial statement we're going to prepare is the income statement. This doesn't show the heading, but just as a reminder, the heading is always, the first line is the name of the company, the second line is the name of the financial statement, and the third line is the date. And an income statement is for month ended. So we start with our revenue. You put the word revenue as a section heading, and then you put the account. Remember, these are not debit credit columns. They are total and a column for calculations. We only have one sales account, so it comes to the second column. Then you list expenses section heading. Then you list all your expenses and their amounts. Then you add them together and you put total expenses. You add them together, put that here. You're going to subtract your expenses from your revenue, and that gives you your net income. And that net income should match the net income on your worksheet. Then we do a statement of owner's equity. And the point of the statement of owner's equity is to bring your capital account up to date, because capital is where we keep track of the owner's rights to the assets of the business. So anytime the owner invests money, it goes into capital. And so we're going to put, again, you have your heading, again, not debit credit, but we have capital account in the second column. Then you have net income, and you're going to subtract your drawing, which is the money the owner's taken out, from your net income. And so this minus this equals this amount. It goes right there. Then that is what you're going to add into capital to show your new updated capital. Basically, you're adding in your net income, subtracting out your drawing. If you had a net loss, if this was a net loss, then because a net loss will decrease capital, you would add drawing and loss together and then subtract it from your capital, because it would decrease your capital. Then we do a balance sheet. The balance sheet has a left and a right side because our accounting equation has a left and a right side. Assets are on the left, liabilities and owner's equity are on the right. So we're going to list assets. We're going to center the word assets on the first line, then list all of your assets and their amounts. Don't do the total yet, though. Notice that's steps 5 and 6. So you're going to list your assets. Then you're going to come over on the right-hand side. You're going to center liabilities. You're going to list your liabilities, their total amount, add them together. All of these amounts come from the worksheet. Then you're going to list owner's equity and capital. Now, the difference here is that this capital account does not come from the worksheet. It comes from your statement of owner's equity, because you just updated your capital account. So you put that updated capital account there. Then our accounting equation is assets equals liabilities plus owner's equity. So we're going to add our liabilities and our owner's equity to get this amount. Add your assets. These two balances have to equal. If they do not, you have a mistake and you got to figure it out. Most likely, your first mistake to check on a balance sheet is to make sure you use the correct capital amount. You're going to bring these so that they are down on the same line. So notice that we skipped a line here because we want these two to be on the same line. Just because this is a balance sheet, having them on the same line shows everything in balance. It's nice, neat, easy to read, put together. And that's how you do your balance sheet. So far we've done steps 1 through 6 on the accounting cycle. Chapter 8 will get us through 7 and 8.